Welcome to Private Lending Insights. I'm your host, Rocky Butani. In this episode, I interviewed Bryan Ziegenfuse and Chris Tereo from Cities. This is a national private lending firm based in Philadelphia that specializes in construction loans and heavy rehab loans, but they also do DSCR rental loans. Cities funded over $800 million in private mortgages in 2024, and they're probably going to top that by the end of 2025. We talked about their lending activity in 2025, the markets that they're currently active in, the markets they're excited about growing into, the trends that they're seeing, defaults, foreclosures, and their predictions for 2026. We also spent a bunch of time talking about their construction loans and the guidelines for their loans, so you'll get an update on the maximum leverages, the pricing, borrower requirements, and more. We talked a little bit about DSCR loans. We talked a little bit about their company history, their operation, and capital markets. We've been doing business with Cities since 2021. I've personally been to their office a few times in Philadelphia to visit them. Co-founders are great guys. They've built a great company, have a great culture, and a great brand. I hope you find this episode to be insightful. Here's my interview with Cities. All right, gentlemen, thanks for joining me for this episode of Private Lending Insights. How's everything at IFC?
Good, man. Staying busy.
Yeah, I could see that. Give us a summary of how 2025 has been for you so far and maybe compared to previous years.
So we started out the year thinking we were going to grow maybe about 20 to 30% year over year. We're hitting the high end of that range from a volume standpoint. I think what's been most kind of exciting about the platform year over year is kind of the continued, our business model has been centered around kind of local boots on the ground, folks that are out in the field, kind of, meeting builders, meeting developers, and that strategy, that commitment to the local approach has been incredible for us. And so we've doubled down on that strategy. We've doubled down in the Carolinas, Florida, Texas, Tennessee. And so that's a lot of the time and effort of the company. And so had a killer 2025 and 2026 is looking even better.
Love it. That sounds great. When I look at your stats on Forecasa, what's different with Cities compared to other lenders is your numbers have increased consistently from 2022, 23, 24, and 25, whereas a lot of other lenders that I track, they had an amazing year in 22 and 23, and then it's gone downward from there for 2024 and 2025 as well. So yeah, like you said, your 20 to 30% growth seems to have been justified by the numbers, and that's looking great.
I think we're one of the larger, if not the largest, kind of privately held company lender in this space. And so, our growth has been dictated upon us. We own, managing through credit, building out our credit, our operations, making sure that we're delivering an incredible experience to the customers. And so we weren't just there to fill a credit box and pump as much volume as we could. It's been a methodical, targeted approach to growing the company. So,
yeah, and the numbers I saw in Forecasa were put you at about $670 million in loans through October, and about 1,600 plus loans. In terms of the number of loans that were funded, does that sound about right?
We stacked on a few more loans since those numbers, but yeah, that's close.
We'll probably hit about 850, just under 850 to 900 million for the year is probably where we'll end up.
Wow, that's incredible. Congrats on all the growth, and you guys are doing good, and it's been fun to watch you grow over the years.
Appreciate that. To piggyback on what Brad said too, when you look at the top 10 lenders in the market, IFC's in the top 10, and being privately owned, that's kind of what we tell our customers. It's having the local boots on the ground, but also since inception, it's always been about customer experience. So it's about having a sticky platform. Like when someone does a loan with IFC, it's pretty hard to leave. and that's because of the team, the customer experience, the service, and that's really what we pride ourselves on.
And speaking of boots on the ground, which markets are you in, or which markets do you have boots on the ground in?
So I'll take this one. I'm heading to Texas next week. So we got 3 reps, soon to be 4 there. Florida, we have a satellite office. North Carolina is basically like HQ2 at this point. So we're headquartered in Philadelphia, but Charlotte, North Carolina, we have 3 reps and a processor there, as well as someone in Raleigh and someone in Charleston as well. So the Carolinas are big for us.
Okay, so those are your main markets. There's obviously Pennsylvania, Florida, Texas, and the Carolinas. Are there any other markets that you're really pushing to grow in the next year, or any markets you're excited about?
Yeah, you've got Tennessee that we've got an office there. Ohio, we're very active in Ohio and growing in Ohio, kind of that Columbus, the greater Columbus area. And then Georgia is another area, another market that we'll hopefully have an office there shortly. And then heading a little bit further out on the West Coast is the Arizona, Phoenix area at some point in 2026.
So what we like about those markets, so me and Ryan, who's not on here, but we're the ones primarily traveling to these markets. So I was just in Nashville. What you see in, the suburbs of, not, downtown Nashville, but in the suburbs, these perimeter counties, as well as Ohio, is, you look at the shortage in housing in the country. You see a lot of the workforce type housing more affordable. And that's what we're really targeting, going to those builders, investors, flippers, land developers, and seeing them face to face. That's really what we're targeting. That's what the country needs. I mean, if you look at affordability and housing.
Absolutely. And so let's break down the loan type. So out of all the loans that you funded this year, give us an estimate of the breakdown of ground up construction versus fix and flip or rehab, and DSCR rental loans.
Yeah, it's literally kind of half and half for us right now. So you're seeing rates come down, right, over the past 6 months on the DSCR side, and you had a lot of people that opted out of, in COVID when rates were super low, they opted out of the 30-year fix at 4.25 and took the 5-year at 4, right? Just because they wanted the little extra spread on rate. So now you're seeing those start to balloon and come due. So we're seeing sort of a big refi boom, especially now that rates are kind of coming down. So people that refied in the mid 8s, low 8s, high 7s, they're now starting to come back. And if they didn't do a prepay penalty, it's starting to make sense to look at the numbers and do a bunch of refi. So for that reason, to answer your question, I'd say it's 50, 60, 40 right now rental. And then we're kind of split bridge, fix and flip, and new construction.
Are there any trends that you've seen lately outside of the DSCR rates and refinances? Any trends that have been prevalent in 2025?
There clearly that new construction has been an important, as fix and flip loans, as developers that might have been rehabbing properties. They've looked for maybe some infill new construction opportunities, have gotten more comfortable maybe with new construction with their general contractors. And so we've clearly seen developers, our customers, move a little bit more towards new construction for fix and flip. And we've got one of the larger new construction platforms. And so that's one of the reasons that's helped out some of the growth, is you're seeing some of that migration over, and they're looking for lenders that could kind of straddle both strategies, whether they're rehabbing to sell or maybe some infill ground up construction. Those have been the primary areas that we've seen.
I spoke at a mastermind last night too, and the same question. It's funny because it's two opposite ends of the spectrum. You got a lot of guys pushing into new construction, absolutely, and those that bought it cash and now they're repositioning and refining into a construction loan, they're crushing it. On the other side is you have fix and flippers that maybe were doing the heavy full gut rehab, you now see them opting for the cosmetic light, get in and out, almost, wholetailing type deals, just to get in and out quicker as construction costs are still pretty high. We're kind of seeing both of those right now.
Nice. And have you experienced an uptick in defaults or foreclosures?
Yeah, the answer is yes, we have. It seems like it's been geography based, is what we've been able to tell. So some of the areas where supply has crept up, maybe before, a good comparison is like, what was supply in 2017, 18, and 19 compared to today? And because you had a natural dip in supply during the 21, 22 vintages. And so as that supply's picked up, we are seeing certain markets have an uptick in delinquencies. Some of those are, some of those markets are the Florida, specifically on the West Coast, the Cape Corals, Fort Myers, Cape Coral, some Tampa has picked up. The Pennsylvania, specific to Philadelphia, our home market here, we've seen delinquencies pick up. And I think some of that's attributable to the fact of folks that went into the strategy, into the build, into the development as, hey, I was going to go sell this project. And now they're sitting out there, they've got a little bit longer of carry costs on a property, which could be taxes, insurance, and the loans themselves. And so, we are seeing a pickup in delinquencies there. And so I think one of the things we've been trying to explain through our monthly webinar process, our capital markets updates, is evaluating those options consistently through the project and having fallback strategies. People clearly think in certain markets that rents are performing well. Like, you haven't seen rents decline by 20% or something like that. You might have a temporary blip on a for sale product, but it still works from a rental standpoint. And so as people evaluate those strategies, do they really want to own the property through a rental, or do they want to just sell it and take a reduction in the purchase price and move on? Is really evaluating that strategy month after month as you're going through the project and getting faster at your decision making. I think could clearly help out folks that are entering kind of that challenging period if they're trying to sell the property.
And do you expect defaults, delinquencies to increase into next year, or do you think the worst is behind us in terms of defaults?
The magical forecasting. So we've been looking at a lot of home builder data over the last probably 12, over 12 months actually at this point. I can't believe it. But we look at a lot of home builder data. We purchase a lot of home builder data. We look at supply. We look at what lots are coming online from a pipeline standpoint, permits. And so we think there's still fundamentally not enough houses, and it's burden, it's up against itself as like this affordability construct. So can the person that's living in that town, that community, that county, can they afford that product? And right now with rates at 6 to 7%, they're struggling to afford it, where home prices are. And so there's some give and take that's going to need to happen as income levels move higher year after year, rates maybe come down, home prices maybe come down a little bit. And so there'll be a natural point of clearing that'll happen over time. We're expecting, depending upon the vintage, depending upon the areas, that those delinquencies are kind of peaking and are trending in the right direction, especially as we look at, here's something that was a project that was taken on 2 years ago versus a project that was taken on and underwritten 6 months ago. And so we are seeing, I think, going to see that natural decline across the board. But some markets might be a little bit longer to clear that inventory.
And when you say vintage, you just mean that the year that the loan was originated or funded, right? So like if it was 2022, then But well, that's a long time. That's 3 years ago.
That's 3 years ago. But yeah, some projects are a little bit longer. Some projects take a little while. And so, yeah, that when I say vintage, I mean like the developer went in and said, I'm going to go do this project. And if they went in 2022, they went in 2023, they went in 2024, they went in 2025, those vintages um, are, I think that's what I mean by vintage is when the developer went into the projects. And so another key thing that's hurting to, is really an appreciation for the timeline in which the city is going to um, grant approvals for the project, the, making sure the general contractor is doing things in accordance with what the building code is in that region, and having inspectors come out and then issue approvals. The cities don't appear to be moving. I was just out in Los Angeles, and we've got a couple projects out there, and no one had anything nice to say about the Los Angeles County building department, approval department.
Yep, no surprise there. That's the way it is in a lot of California, unfortunately. So aside from defaults or delinquencies, any other predictions you have for next year?
Yeah, I mean, look, I think that so I'm on the sales side, Rocky. So my prediction is there's going to be more and more liquidity into our private credit industry here, and there's a lot of lenders being put into business and some being put out of business. But there's a lot of noise in the market. So you mentioned forecast and looking at the lenders. I mean, it's more important than ever for customers to not only get good terms from lenders, but also know those lenders and make sure they can execute and stand the test of time. So my prediction is there's going to be more liquidity put into the market because, the hedge funds and institutional money is always after the residential notes. So for us, it's important to, make sure we offer good customer service and continue to diversify and offer new products. I think you're going to see a big push towards higher leverages, right? Maybe lower rates. It's going to get more competitive. Margins are going to get thinner. So I think that's a big factor for next year.
For next year, I think I think the capital markets feels like it's pretty well supportive of this space, whether that's rental loans, new construction projects, fix and flip, fix to hold, all those types of projects. And so the capital markets feels pretty sound and pretty it becoming more and more institutionalized, and capital likes to get is looking to probably increase their allocation towards this segment. I think that so what that means to investors is what Chris just mentioned, where it's a little bit tighter margins. I think there is a natural slowdown happening. When you look at permit data for single family homes, you're definitely seeing kind of a growing share in the public home builders that build those types of communities. I think that creates a lot of opportunity over the next, whatever number of months, years. I think that's creating a lot of opportunities for kind of our, the borrowers that we're talking to really play in the infill space, play in the development of subdividing properties. They're not looking to develop 150 lots and then put 150 homes. It's those smaller infill projects, and I think if the and so I see that as a growing need, a growing area. People want to live close to the city, urban areas. And so I think that's going to continue to be a pretty big, opportunity for developers. And then, as far as rates, everybody loves to ask us where are rates going, where are rates going. We did a long segment on interest rates. We actually said it over a year and a half ago that don't expect rates to come much lower. Don't expect rates to come much that lower. We're still kind of a believer in that rates kind of trend horizontally with some range bound movements. And what does that mean? Lower, right now we're running at 6.25% maybe on a 30-year fixed, is maybe it toggles plus or minus 25, 35, 50 basis points in a range. But no like a 5% mortgage doesn't feel like it's going to it's going to happen in the near term.
All right. And then since you mentioned capital markets, is there kind of a different appetite for ground up construction projects versus fix and flip? I mean, does that typically get spread between different note buyers, or do you typically have a secondary market company that buys both new construction and fix and flip, or is it separated?
There's a balanced appetite because we look at things if we're going to close, a half a billion, 600 million next year of bridge and construction loans. We are looking for some type of balance and where it's not all fix and flip, it's not all new construction. We've been a platform that has supported new construction since we started in 2018, 2019. That's been key. Ryan, Chris, were kind of instrumental in educating our capital partners in how we manage that construction risk, how we manage that execution risk. And so we've built a track record to support new construction. And so the capital partners that our balance sheet, the capital partners we've worked with, we've got a long-standing relationship. And so it does, when you look at some of our competitors that are out there, they're executing towards sometimes securitization related executions, and there's limitations in those deals, in those transactions, of how much new construction should go in it. We're actively trying to work with some of the rating agencies around kind of better definitions around new construction, weather tight, shells, foundations, and different types of milestones that can, maybe open up some more capital, maybe some more allocations to drive a higher mix of construction versus fix and flip.
To Brian's point, just because a lender has the liquidity or the products to offer new construction, you as a customer need to make sure they have the expertise in building or managing new construction so that your project between draws and originating the loan, it goes smoothly for you. So you're in and out of those, because we're not talking about light rehab, fix and flips. They're new construction. And a lot of lenders could have the product to offer. One of the larger lenders out there, I won't name names, but it rhymes with Shmiavi, might not offer that product, but an iFund Cities will, and we have experience in building it ourselves.
Great. And so on the subject of ground up construction, why don't we get into some of the guidelines and the actual construction loan program to talk about some specifics for our audience. Could you give us just an overview of the construction program in terms of the minimum maximum loan amount? We'll get into leverage and the project sizes, whatever you could share on that. Just a general overview would be great.
Yeah, for sure. So obviously it's like everything else in the bridge side, it's heavily driven by experience, and execution ability. And it's also driven by the out sale, right? Are we talking about $200,000, workforce type housing project, maybe a townhome development? Or are we talking about a luxury spec single family in Charleston, right? So you do have to look at the project itself paired with the experience of the sponsor. If you want a general range, 80 to 90 LTC, so loan to cost, total cost purchase plus your hard and soft construction, that's what you're usually looking at, with the majority going at 85 LTC on new construction ground up.
And are you just funding the vertical? How does the land play into your loans?
Yeah, good question. So we don't take entitlement risk, and most lenders don't. They shouldn't, because you don't really get leverage on just raw land. So assuming you have plans, permits, and you're technically shovel ready. So in some counties, it's different. Like you might have the zoning approval and zoning plans, and maybe not your actual building permit, which maybe will come 30 days from now. We'll still close that loan, but we don't take entitlement risk. So as long as you have the approvals in place and plans, so we can actually value the property, we will close that loan.
And do you take the value of that land into the total loan to cost?
Yeah. Yeah. So it's called the imputed equity that you could build in the land as long as you bought it and the land is seasoned. That's where a lot of these, astute investors I mentioned they're crushing it earlier. If they've been land banking or raising equity to take down land, buying land for $250,000 is one lot. And then maybe over the course of a year, they subdivide it into three buildable lots for three single families or three townhomes. Each one of those lots then appraises for 75K or 100K. You're building equity, right? So then when we go to originate the loan, we're going to look at the as is value of the land plus your construction as opposed to the original purchase price plus your construction. And at that point, LTC becomes more relevant, right? In some cases, getting above 90 because if you're using that imputed equity value.
Could you define seasoned in terms of how you look at the construction loans? Is there a time period?
12 months, yeah. And I mean, that's assuming you're buying it and actually adding value, like getting raw land and getting it entitled versus just like buying land, not really doing anything. You're in a declining market, then yeah, it's not like you're going to build a ton of equity in that land.
Sure, makes sense. And how about the different project types or the project sizes? Are you doing projects with multiple single family homes, multiple townhomes? Tell us a little bit more about the project types.
So we'll do $20 million, $30 million loans in which there's multiple townhomes, there's multiple single families. It's a development. The loan size is kind of driven. We don't govern it as much as we're not looking. We're not doing new construction in the Hamptons where it's a $15 million home. That's not it's a 10,000 square foot home. It's got all the bells and whistles, and that's not our what we're going to shy away from. What we're going to look to leg into is does the product that's being built match the community in which being built in and so we do, like, we'll call it a comparable market analysis, a CMA. And so we'll look to drive, all right, it meets what we're expecting to be, the average median new home sale price in the community, in that county, in that zip code, whatever it might be. And that really we look to govern ourselves and look at those types of projects. We're not looking to go, here's the one house that's worth $5 million when all the other houses are selling for $1 million. That's more like how we look to underwrite projects. We don't really govern ourselves on kind of loan size and project size.
Okay, and going back to the leverage, I forgot to ask earlier. How do you determine the amount of leverage that a investor gets? Is it just based on their experience, whether they get 80% loan to cost, 85 or 90?
It's a combination. We're going to look at experience plus what is the project, how long does it take to build, and what's the complexity of it. And so for a project that might be a larger project, more townhomes, it's going to fall in that lower leverage bucket, even though they maybe they've got a ton of experience in the lower leverage bucket just because of the complexity of the project. And then as we move towards it's an infill project, the experience that they've got the other 20 that they just completed underneath their belt, and they're rolling into the next 20. That's going to fall into a much higher leverage bucket, especially when, again, we're going to look at more what's the geography, what's the zip code, county level data telling us as far as that, as far as how vanilla does that project look in the market. And so that's where we'll govern ourselves. We typically there is what's our loan to the stabilized value, typically referred to as loan to ARV. And so we'll look to manage that typically right around 70 is what we hit on. And then majority of the time it's that LTC kind of calculation that really governs the loan of how high we'll go.
Great. And could you tell us a little bit about how much you've been pricing deals at for most of this year in terms of interest rate and points?
The magical question, interest rates. Yeah, it's anywhere. Yeah, fix and flip could be anywhere from I don't know, mid to high eights to if for like velocity, I'm going to turn this in 6 months, all the way up to kind of 10.5 for fix and flip, and then you kind of move a point wider on new construction than fix and flip.
So new construction somewhere between 9.5 and 11.5.
Yeah.
Okay. Great. Yeah, I didn't realize rates were that low for construction. I
Yeah.
would think
I
10 and
plead
a
the
half
fifth.
minimum.
Yeah. Yeah, I know.
That's great. And how about origination fees, points? What's your typical been these days?
It depends for fix
Whatever
and
gets
flip.
the deal done.
Yeah, new fix and flip to new construction, 1 to 2 points is
Okay.
the range.
Yeah.
All right. Sounds great. Okay. And then how about we talked about doing bigger projects with multiple homes. How about multifamily properties? Is that something that you're offering at this time?
We don't touch them that much. We'll do them for core customers that have been with us for a while. We know they can execute. We have products for 5 to 10 units, really, or maybe a little bit bigger, on the bridge, fix and flip, fix to rent, DSCR side. We just don't do a ton of the ground up multifamily. Like I said, unless it's like core sponsor, core market, we love it, everything about it, then we might.
Okay. And are you getting a lot of requests for these small multifamily properties?
Yeah, I mean, I can tell you from my side, yeah, we do see them. Maybe not as much. They're very hard to pencil with, as rates are coming down now. I think it's easier to underwrite the exit, and your debt yield exiting. But I don't know. For a while, it was kind of like, we know a lot of guys that got jammed up with the multifamily development because they pro forma a 5.5% rate and they got caught with an 8.5 on the exit. So I think it kind of scared a lot of people away from multifamily development. Now maybe that's coming back a little now because you're seeing deals, but
Yeah, definitely makes sense. And going back to what you were saying about how it's important to have a lender that knows ground of construction really well. How are you guys dealing with inspections these days for draws? Are you using any software systems where it's a bit more automated, or are you still sending people out to do physical inspections?
yeah, we do both. We give the customers the option to pick because we do a virtual inspection. That's what most people opt for. You log in, you see your project name, click it. You get a link sent to your phone or a PM project manager on site. They take pictures of everything you're looking to draw on. It gets uploaded. We review it. We fund you. That whole process, soup to nuts, is typically 2 to 3 business days. We've done faster. We've done later if people get jammed up. But that's the usual process. We still have the ability to send an inspector, especially on these larger projects. Like if you're building 5 townhomes, it's not necessarily feasible to go in and take pictures of framing of 5 homes. If you're the developer, sometimes that's a little time consuming. But we have people that do it. So we give you the option. And one of the benefits of having local boots on the ground is we do have local resources in the market that know construction, right? And they know that market. They're in, they're out, right? So that's been a big benefit to our draw process.
So even if someone does the inspection process, you still have, if you have a local rep, you'll send them out there just to get eyes on the deal, right?
Oh yeah, our local reps are definitely out at the projects for sure.
Nice. And how about borrower requirements? What are your requirements for experience? How many projects does that mean? And how about credit score and liquidity?
Yeah, there's different buckets, right? So, maybe 0 to 1 deals get you X leverage, 2 to 3 gets you Y. I could tell you that the top leverage you're looking for, it's, maybe 6+ deals, 700+ FICO. If you're, how can I be an attractive borrower, right, to lenders? It's having 6 or more deals experience and a 700+ FICO, right? We work with plenty of people that are more getting started, 2 to 3, and lower FICOs, but it's all about what's on your credit score too. A lot of people, when I was in construction too, you use your credit card to fund a lot of materials, right? And it's that utilization depends on the time of month that you check your credit. You could be a 670 or a 770, right? Depending on the time of the year. So it's important to look at the credit report and actually understand what's going on versus a 620 that has a bunch of late payments, and that's going to be tough for a lender to wrap their heads around.
Nice, that makes sense. And how about the minimum experience? You said 2 projects would be a minimum for a ground up construction loan.
That's ideal. I mean, we've done 1 deal experience, but there's also other factors. Do you have a verified GC that is in the market that we know and trust, right? Because that takes half, if not more, of the execution risk off the table. So I'll say we definitely love to get creative with our borrowers. If we could find a way, we'll do it.
Okay. And how about real estate investors that have done flips and then they need to get into ground up construction now because they're not finding enough flip deals? What's your take on those?
That's exactly right. That you got to have a verified GC. So we have to have a GC verification process for that, for exactly people going from flip to new construction. So we can make sure we're comfortable with the GC. Also, it's for the borrowers too. Make sure if it's their first ground up and they're using a GC, chances are it's the first time they're working with them, right? So it helps us verify the GC just as much for them as it is for us. Yeah, in addition, you look at the level of rehab. So if you're someone that has 8 cosmetic rehabs versus 5 full gut rehabs and 3 cosmetic rehabs, we're more likely to give better terms to the person that has the full gut rehab, right? It's not just 5 or 10K paint, carpet, and relist it. They have experience in more heavy rehab.
All right. And how about the exit strategy? Have you seen most of your borrowers exiting with a sale, or has the rental strategy been more popular this year?
If Bryan, you want to take it, but I'll say rental is very popular as an exit strategy.
Yeah, that's right. I think you see rentals as a core part of how people are looking to exit some of these projects. And so that's what we'd spend a lot of time on our asset management front. We've got an entire team that works alongside the customers throughout the project, is making sure that they've got the ability, do they, what would they qualify in a DSCR loan, how to make it happen seamlessly once the construction's done. And so we have new construction projects that get done in 120 days, and we're putting them right in a rental loan afterwards.
Wow, amazing. I would expect it would take a lot longer than that.
Some guys have machines, especially down in Dallas, Tech. Like some of the folks down in Dallas they're just like machines.
Yeah. The build to rent product is what you could do that with. It's not the more luxury high end stuff, right?
Sure, makes sense. And in those cases, are they typically doing it with with multiple homes, or do you find a lot of people doing built to rent strategy with a single property?
Not as much with a single property. Yeah, it's usually multiple property. Hard to make the numbers work on that, right?
Sure. And how about townhomes versus a detached single family? What's more popular these days, or does it depend on the market?
Yeah, it depends on the market. Like we've seen Charlotte townhomes get oversupplied in the last few quarters here, and so they're clearly sticking around longer. And so it's definitely market dependent.
Yeah, we just underwrote a deal outside of Nashville, and he could have pushed for 82 units, which would have been however many number of 6-unit multifamilies, right? But he opted for 52 units, like 13, I think it's 13 quadplexes, right? And there's 2 things there. It's like passive lease resistance, so it's like he knew he would have been able to get the approvals for those sooner than the multifamily. And also, you need to ask yourself as an investor, like, what is the liquidity out there for this asset class? So you're talking at least 5%, if not more, reduction on leverage for those going from 1 to 4 unit resi to commercial multifamily, 5+ units, right? And also rates. It typically it's more expensive. So there's just less liquidity out there, and that's the reason for that, because those assets are less liquid. It's harder to sell a 6-unit multifamily than it is to sell a single family home.
Why don't we switch gears to talk a little bit about rehab loans, and just a few of the important points for a fix and flip, a heavy rehab, or a light cosmetic rehab. What are you looking at in terms of maximum leverage for 2025?
If you've got the experience, you've got a good FICO score, we're going as high as 90% of the purchase price and 100% of the rehab. Some deals will do 95% loan to cost. Chris has been looking at, and we've executed on a bunch of deals in the past few months now that are called more transactional funding, in which we provide financing to folks that are just holding the properties for 2 to 3 months, call it, and that we've been working towards, and so that leverage is pretty high. We've seen, as regulations come out from different states regarding property flipping, has been an opportunity for wholesalers to take down properties, possibly fix them or list them right away, or list them quickly after, and so they're actually taking title to the property. And so for light rehabs, though, 70% of the value of the stabilized value as the repair value, the retail value, is where we'll end up. And leverage is high, rates are low, and it's a good time to be a borrower if you're doing that.
Brian and Ryan were just saying the other day, and we might just start a fix and flip business, given all the leverage out there. Go back to it.
Yeah, nice. So as far as the loan to after repair value, have you seen other competitors going up higher, like 75% ARV and versus 70?
Yeah, so we lend up to 75. Yeah.
Okay.
75 is pretty industry standard.
Okay. Nice. And that also, I'm assuming, varies depending on experience.
Yeah, I would say less. That's more property driven, I would say. Like, yeah, sure, experience, or maybe if you're doing more luxury, single family, new construction, I think you want to haircut the ARVs a little bit. But yeah, it's more property driven, or maybe geography.
And you mentioned the pricing earlier. You said for this year, you've been somewhere in the range of 8.5% to 10.5% for rehab deals.
Yeah, I'd say it's all about, just as it is for our borrowers, it's all about volume, right? So the more we could do with someone, get better execution on our end, we'll be able to extend that to the borrowers.
How about experience requirements for rehab loans versus new construction? How do you look at experience?
Yeah, I'll take rehab. Like I said, we've done it with one deal experience, right? As long as we have a good project and a good GC. Also, if the leverage is right, there's so many factors that go into it. So I'd say if you have a deal, and you have a strong FICO and liquidity, we didn't really talk about liquidity on this call yet, but liquidity is super important to the success of these deals, especially rehabs. When look, like new construction, you go in and exactly, like, here's your foundation, you got you're starting from scratch. Renovation loans, I mean, there's a lot of risk. Take down a wall and there's black mold you weren't accounting for. There's structural issues. You have to knock things down. That's why liquidity is so important, to have working capital. Once we originate these loans, you can't really increase your budgets, right? So if you run out of contingency and you don't have liquidity and working capital, or you're spread thin, it's going to be tough to get through that project.
And is there a certain percentage that you look at in terms of what the liquidity requirement is? Is it a percentage of the rehab budget, percentage of the total project cost?
It's whatever that cash to close is, that number. 6 months of IR, and roughly 10% of the budget liquid, that's like a good ballpark figure, right? It's not like a one size fits all, but that's roughly what you should be looking at.
And do you just verify that by looking at bank statements that hey, this is how much cash you have liquid in the bank account?
Yep, bank statements, and then depending on exposure, maybe we'll ask for a PFS, but to do a deal with us, it's just bank statements, liquidity.
Great. All right. Well, with that, why don't we take a quick break and we'll be right back. Support for this show comes from Forecasa, an amazing data platform for private lending and real estate investing. Private lenders, note buyers, capital providers, real estate investors use Forecasa in a variety of different ways. You can see which lenders have funded which loans. You could see which real estate investors have gotten funding or sold a property or purchased a property. You can see loan assignments to know where the loan was sold to after funding. Many people use Forecasa as a prospecting tool. I personally use it to vet lenders and for general market insights. It's become an essential part of our business, and I just wish I had access to it sooner. We publish some of Forecasa's data on privatelenderlink.com. When you do a search for lenders, you could see the top 20 lenders in each market, and we've also added the top real estate investors in each state and for some of the metro areas. Visit forecasa.com to schedule a demo, and please mention that you heard about them from LenderLink and the Private Lending Insights podcast. All right, and we're back with iFund Cities. Gentlemen, let's talk a little bit about DSCR loans, since that's been a major loan product for you for this year and may likely be even more popular next year and in the future as interest rates come down. But for 2025, have the majority of the DSCR loans you've done been refinances or purchases?
Yeah, the majority of refinances, either out of construction loans, rehab loans, or just existing debt that is on the property. Maybe they took it out a few years ago, or maybe they're coming off of a bank loans. Typically, like, banks might only provide 5-7 years on rental properties, and so people that don't want to deal with the banks every 5 to 7 years typically, eventually will land over in kind of our world, and so we've been able to refinance out a lot of those shorter term bank loans.
And you talked a little bit about interest rates earlier, but what about leverage? What's been the maximum leverage for this year?
Yeah. I mean, on a purchase transaction, we'll go all the way up to 80. If it's a refinance and they're cashing out, it's typically right around 75.
And earlier this year, there was this fraud scheme that occurred in Baltimore with an investor cashing out equity, but inflating the values with the help of appraisers. Did that affect your company in any way?
Yeah, absolutely. I mean, we didn't have any exposure to that borrower, or borrowers plural, or those people plural. We didn't have any exposure, thank goodness, but that sent a lot of shockwaves through the industry. It's hurt the Baltimore market. It's hurt exposure limits for folks that are larger investors in our space. It's had a lot of impact. It allowed people to take a look at non-arm length transactions. It took people spending more time looking at appraisal companies. They've been updating in the world, in the credit risk world. In the credit risk world, people call it exclusionary lists. They call it like bad actors or people that bad quality. And so every institution, including ourselves, took a real hard look at all of the appraisal companies we're using, the title companies we're using, the borrowers, and have updated kind of our exclusionary list. But yeah, that had a major impact on the industry, and it's a shame.
How about appraisals moving forward? Have you had to do additional appraisals or in-house valuations as a result of this?
Yeah, so our underwriting team uses a handful of tools to review valuation reports, along with having thousands of transactions to look at. We do look back analysis all the time on credit decisions that were made. We think it's a good process for a company to do those types of look back and analysis. We do it with our investors, we do it with ourselves. And so, we've enhanced valuation tools. We've we built a large data lake of third-party data sources that we ingest in each, day or month. And so that's been an important component to our underwriting practices to validate how these appraisal companies are tagging properties with values.
And how about the loan sizes over the last 12 months of what's the maximum loan amount that you could do for a DSCR loan?
It's it goes down to the property type. So we're typically not putting luxury properties into DSCR loans. We do portfolio rental property loans, and so we just closed 20 million of portfolio loans for one borrower in the last 2 weeks. Maybe it's like 20, a little over 20 million. And so those were, a lot of properties pushed into a portfolio loan. We've got another one that's like 6 million across 30 properties, I think is the number, 5.8 million across 30 properties, that we're putting into portfolio loans. And so that's more how we look at it. We're not, if you're doing an Airbnb, we're typically not on luxury. Here's a luxury Airbnb, Hamptons, Miami, Miami Beach. That's not what we're going to look to do. Condos in Miami, condos in Florida, like luxury stuff. We're typically just going to shy a little bit more away from.
The max loan per single asset it should be around 2.5 million, if that's helpful. But you got a $7 million home and they want 50 LTV. It sounds great, but it's not really the right product.
Sure. And what about the minimum?
100K is the minimum.
All right. Sounds good. All right. Why don't we switch gears and talk a little bit about the company, about iFund Cities. First of all, could you tell us a little bit about the name of the company? How did you come up with this? This is a very unique name. I like it. I think it's a great brand. But how did you come up with it, and tell us a bit more about that?
The other guy who's not on here, Ryan Herding, founder. I was investing in real estate, back in 2017, 2016. Met Ryan. He invested in one of my deals, and kind of said, "Hey, we should start a lending company." I'm like, "Sounds great." We didn't know how to originate a mortgage at the time. We were real estate guys and sales guys. So Bryan came in, kind of put the engine in the car, and together, differing but complementing skill sets. So the name, kind of just came up. It was originally iFund Philly, actually. So it kind of rolled off the tongue a little differently. I guess we didn't really plan to be a national lender. Glad we did change the name. Started with iFund Philly, and then we started doing loans in Pittsburgh and New Jersey. It didn't really stick. People were like, "We hate Philly," so we were forced to change the name.
Why would anyone hate Philly? That's terrible.
Yeah, right. Go Birds.
All right. And how about the operation? Tell us about how many people you have, office locations. Obviously, you said you're in Philly. Tell us a little bit more about the operation.
Yeah, so we've got a large operation now, well over 100 people. Location wise, about, right around 30, 31 in Philadelphia, another kind of 20 across the US. And then we do leverage, we've got a team of over, probably close to 60 in Bangalore, India. They're working in office for us over there, providing a lot of the back office support, processing to really make the US team instrumental in delivering good service and having them pay attention to the customer and answer questions, answer phones. And so that's the makeup kind of of the company. You've got a construction management team, asset management team between Philadelphia and Dallas, Texas. And you got sales, account managers, processing across all the regions in the U.S. that we mentioned. And you've got our capital markets team, technology team based in Philadelphia.
Wow, that's impressive. Speaking of capital markets, tell us a little bit about the capital source and the structure. Do you guys run a fund and then you fund the loans with your fund and then sell them? How does that all work?
Yeah, so we've got a balance sheet that allows us the ability to do, close to 100, run a balance sheet that's probably about 170, if we wanted to, up to 175 to 200 million. We typically don't run that large. However, in order to cycle, in order to close $1 billion, close to $1 billion worth of transactions, we do leverage capital, typically through firms that are either managing capital for insurance companies, managing capital, for pension funds, endowments, money managers, or firms that are ultimately securitizing certain loans that we're originating. And so we do work with a multitude of different investment managers. And why that's important is we're not beholden to one investment manager's mandate or strategy. And so some strategies are purely securitization. Some strategies are purely insurance capital. And so having a diverse set of strategies that align with where iFund Cities is going has been super important to us. Super important through different cycles. Super important to be able to provide competitive, cheap cost of capital, cheap, more competitive loans than I think most places out there. It's been ability to allow us to kind of ebb and flow, and have a lot of diversification. So when things happened during COVID, or when rates shot up 200 basis points very quickly, the capital was super sticky, and we were able to execute and continue to deliver and originate and close loans and manage our customers and service our customers through that process. And so in addition to that, having the scale, the operations, where we've gone through diligence reviews from your biggest household names across the space up in New York, has, when we send out construction draws, when we manage construction draws, our process, like, you deal with the iFund Cities team, you deal with the iFund Cities platform. And so that it's seamless to the customer around getting those funds timely, quickly. And so that's been, our customers really appreciate that.
I was just going to add one thing. What that ultimately means is for our customers, flexibility, right? So not being beholden to one capital partner, still being 100% privately owned, and having diversified capital partners, running the gamut of lending products, right? That's all that means for our customers, is that flexibility, and that you do really feel like you're still working with a private money lender. We have the national leverages, rates, and terms, but that local lender feel.
Love it. All right, gentlemen, that's all I had on my list for today. Anything else you wanted to add? Anything I might have missed?
We appreciate the time, as always, and call us. We do have some new products we just rolled out. Bryan kind of hinted at. I'm not going to spoil a surprise, but we got some transactional stuff for some wholesalers and fix and flippers. Some new products on the ground up side. So give us a call.
Sure. Would love to learn more about that. Maybe we could do another chat early next year.
Sounds good. And then Rocky, just a big shout out to our team here. They're the ones we mentioned earlier on the call as far as the company's history. We were just named. We were top 10 in the Scotsman Guide. We are one of the top 10 fastest growing companies in the city of Philadelphia. And so a lot of good momentum, and it's you got a great team here for customers to kind of rely on as they're looking to build their businesses.
Nice. And one last thing, you mentioned that you host a webinar periodically. Tell us a little bit more about that and how people can participate.
Yeah, absolutely. So we each month we call it a capital markets webinar. It's a very diversified list of topics that we cover. We try and make it as relevant to our customers as possible. Last month we had on a portfolio manager that runs pensions, 401k money, and we got like the inside look on how people allocate capital at that level, and he, running 25 billion of fixed income. And so we've got next month or next week, we've got a large multifamily general contractor as well as developer himself that moved into single family, and so giving customers a purview of why he did what he did. And so people could sign up, every month. They could reach out to us. We send out links. You could always follow us on the Instagrams, or reach out to our team. Everybody knows how to get connected in to our webinar process. But it's a great forum to get updates on rates, get updates on all those things that are impacting the capital markets.
Cool. Well, I'll try to jump in on one of those and try to be a regular as well.
Love it.
Yeah. All right, gentlemen. Thank you for your time, and look forward to seeing you the next time I'm in Philly.
Awesome. Thanks, Rocky. Appreciate
it. All right. Thanks, guys.
See ya.
And that's a wrap for this episode of Private Lending Insights. iFund Cities has been listed on privatelenderlink.com since 2021. Visit their profile to learn more about their guidelines and find some content that we've produced with them over the years. You can call them directly, send them a short email form, or a long detailed loan request form. When you reach out, please mention that you heard about them from LenderLink and the Private Lending Insights podcast. Thank you for tuning in and listening all the way to the end.